Hello everyone, welcome to our Accounting 312. In this video, we will talk about Chapter 21, Capital Budgeting and Cost Analysis. This chapter is one of the most important and the most useful chapter. And then your final exam, the problem will also be from this chapter. So this chapter from the title, you can say has two parts. First called capital budgeting, then the next one is cost analysis. So for capital budgeting, we will learn four methods. The purpose is, what's the meaning of capital budgeting? Is you budget your capital, right? So it's just for the long term, how will you decide which investment is the best choice? So let's say, think about, hey, you are a millionaire, you are the manager, you are the CEO, you have $1 million, and then you can invest in project A, project B, project C, project D. You know, all of them, they are long-term investment. It's not for 1 year. Most of them last, 3, 4, 5 years. And then how do we decide which project is the best? We will learn four methods in the first part, capital budgeting. So your job is to know the four methods. Your job is to know how to calculate, right? What's the advantage, disadvantage for each method, and then apply that to the CPA question, to multiple choice, to our question preparation for the final. Second part, the cost. Most students, they do well in this part because it's kind of calculation. Cost analysis is the second part. It's harder, I would say. It's very important. I personally think it's one of the, I don't want to scare you, but kind of one of the hardest part. So make sure you pay attention, practice a lot. But once you get it, it really makes a lot of sense. Okay, so now let's get started. I'm not going to read. I think it's really good that you read this chapter, you read the textbook, read the case, the story, so you know what this chapter will talk about. How and when to best allocate your financial resources, basically money, right, among alternative opportunities. So how should we make sure which project is the best one? Sorry, I put some notes here already. Sorry about that. I believe most of you know $100 today worth more than $100 for tomorrow, right? So why? Because it's time value of money. You put $100 today, it will be different because you can put in the bank and earn some interest. So if you knew that, I believe most of you have the general idea of discount cash flow, future value, present value, this kind of factor. If you already knew those things, I would say when you learn the capital budgeting, it's really straightforward. If you say, hey, I don't know what's the meaning of discount factor, I don't know what's the meaning of future value, present value, it's fine. Read textbook, talk to me. Usually I think my videos are better than YouTube videos, but if you don't know what's the meaning of present value, future value, I'll say, hey, just YouTube some, you can get some general idea that helps you to understand our chapter. So we have different learning objectives. The first four, they are for the first part, capital budgeting. So we have four methods. The first two, they rely on one big assumption, which is discounted cash flow. So they focus on cash flow, but we have to discount them back to the present value. Specifically, the two methods are net present value method and internal rate of return method. Our third method is payback method, and the fourth method is accrual accounting rate of return method. So this is the method we focus on our accrual accounting number instead of cash flow. And the fifth learning objective is built on chapter 11. Actually, we still use the relevant information. but we focus on relevant cash flows, relevant cash inflow and cash outflow. We do some cost analysis to find out what cash flows should we use for our calculation of NPV of IRR. So let's say if you have heard of discount factor, you should know there are tables to help you to discount from your future value to the present value. I posted these two tables in the Blackboard. You have a table 2 and table 4. They are also in your textbook. So you say, hey, why there are two discounted tables? Table 2 is present value of $1, and table 4 is present value of annuity. I'll talk more in the next video, but general idea is if it's one-time transaction, hey, you will get $10,000 2 years later. So if it's a one-time transaction, it will be the present value of $1. We use table 2. But if you say you will get $10,000 every year for 2 years, so every year you get $10,000, then that's time we use table 4 of the annuity. So those two tables help you to discount the future value to the present value. Okay, learning objective 1, basically talking about the definition. Capital budgeting is we make long-term planning decision for the investment. So you have alternative, multiple projects, they span for many years. So which one we should focus on, which one should we pick? I'll talk more details of those 4 methods in the next following videos. This video give you general idea of this chapter. We have a lot of CPE questions. I will give you more idea about the problem for the final exam, but just to know this chapter is very important and very useful. You don't know, you never know. Maybe one day you will be a millionaire, billionaire, CEO, CFO, right? You have to make decisions. It's really very, very useful. I like the logic in this chapter. Okay, let me know if you have any question. I see you later.